Okay, we are in conversation with the top management of Hexaware. They missed the expectation across the board across what the brokerages have written. It saw a steeper than expected softness in one of its top clients and softness in the BFS vertical. The management also cut its revenue growth guidance to 17 to 18% from the earlier 19%. We are now joined by R Srikrishna, the CEO of Hexaware Technologies, to talk about the numbers. Thank you, sir, for joining us on BloombergQuint. You've lowered the revenue growth guidance for calendar year 19. What's the key reason for cutting the guidance, sir?
Well, there are actually two or three. The first is that 50 bips of that reduction is simply contributed by currency. The time we gave the 19% guidance was in Q2. From June end to what we're projecting now, there will be a 50 bips full year impact on account of currency. So just this quarter, we lost 60 bips on currency on revenue, but that was for this quarter. We are projecting a 50 bips full quarter impact. So really our 17 to 18, if you kind of keep it as constant currency from Q2, needs to be read as 17.5 to 18.5. So there was, you already mentioned our kind of in-quarter performance was a little bit of a miss. It was not a lot. I mean, our median of analyst expectation was, 212, 213. Our constant currency revenue was 211.7. So it's a little bit of a miss, not a huge amount. A lot of it is driven by sharper than expected softness in one client. And a little bit of a softness in BFS, and we continue to have supply side challenges in all of the verticals, where demand is robust, but supply is a challenge. So it's a combination of these three that kind of led to slightly lower than expectation in Q3, and so that kind of then increases the ask rate for Q4. So we realistically kind of tamped it down a little bit. On the other hand, there is still a range of outcomes possible in Q4, and the predominant determinant of that range, where we are on the range, is going to be furloughs. Q4 is always kind of a furlough intensive quarter. We do expect every year some furloughs, but at this point, we are potentially expecting sharper furloughs than usual. But we don't know, and that's why we've called out a range and we said, hey, where we are in the range, we don't know yet. Furloughs usually we get to know by November end, even December beginning, and that's going to determine where we are in the range. There's also some dependency on, how sharp the fall is in that same client. To be sure, we are expecting a further fall from Q3, that's known, but we just, the extent could be different from what we fully anticipate. So those are the two factors that will impact the range.
So revenues were also hit because of continued weakness in one of the top three accounts client, as you spoke about. How do you propose to address issues like this going ahead? Was this a one-off, or can we see issues like this, more issues like this?
Well, I mean, in this particular client, at this stage, we fully expect, and there is a lot of confidence around that this client issue will bottom out in Q4. So there was an issue Q2 to Q3. There will be an issue Q3 to Q4, but that's where it ends. A lot of it is driven by budget slashes, but they reset the budget year come Jan, much like we do. So we expect this client to come back. If you look at our past 5 years, only this quarter we have acquisition revenues. But our previous 5 years, we've delivered 12.5% organic growth CAGR through client issues. So some client issues are going to, be there on a 3-4 year cycle. But what we've demonstrated consistently is that notwithstanding those client issues, we've delivered stellar growth and often industry-leading growth.
So how do you see performance segment-wise going ahead? Because BFS was quite weak this time around. How do you see the next quarter or the next few quarters in terms of individual verticals?
So, this quarter actually BFS reported numbers were great too, right? And every reported numbers vertical were great, but that was contributed by the acquisition. You take a look at last quarter numbers, it gives you a good sense for BFS versus non-BFS. We really kind of on a dichotomous path. All of our other verticals are truly firing on all cylinders. I mean, there is a range of growth there between kind of teens to high 20s Y&Y growth. So they're doing really, really well. And this includes insurance. So insurance, we don't count as part of BFS. It's a separate vertical as part of a healthcare and insurance vertical together.
So margins have been under slight pressure. Will Q4 face an additional impact from the balance of the wage hike for the year?
So on margins, listen, Q2 to Q3 is hardly an impact. It's 10 bips. We don't think of it as material. On the other hand, our EPS performance has been stellar. What a 10 bips contraction I spoke about was at an EBITDA level. But EPS, we have 21% quarter-on-quarter growth on reported, 16% if on our adjusted GAAP basis, which I think is the right number to look at. Now, it's just not operational performance. It's just not the acquisition. Our ETR, which was already at an industry low, has further come down. So, active tax management strategies, we think is, driving stellar EPS performance. Q4 will have additional, headwinds due to wage hike. In fact, Q4 in general will have lower margins, but that's part of a normal cycle. Every year, Q1 and Q4 are lower margins, Q2 and Q3 are higher margins. And what we tell everyone is that do not look at quarterly cycles, take a look at full year average. And what we said in the beginning of the year, we've stuck to. Beginning of the year, we said our full year average margins for FY18 will be the same as the full year average margins for FY19. And we are well on track to achieve that.
And so my final question, what's your outlook on deal wins for the balance of the year and probably 1 or 2 quarters going into next year?
Well, 1 or 2 quarters going next year, pipeline is strong. Usually in Q4 of each year, which is the quarter we are in, usually tends to be a strong quarter, because people are trying to kind of finish up deals. We'll see. We'll see where it ends. But it's a spiky thing. There's no certainty around closures. But in general, the expectation is Q4 will be a little bit better. On the overall front, our pipeline is robust.
Okay, Mr. Srikrishna, we leave it at that. Thank you so much for speaking to BloombergQuint, and all the best for the 4th quarter now.
Thank you.
Thank you.